Yeah, well, so it seems that 2023 will not be that calm after all. After the first 2 weeks where the market seems to wanted to go up and then skyrocket again, then we're starting to get worried again about a potential companies not declaring the right revenue growth or earnings growth, and now we're not too sure what's gonna happen. So today I decided to cover 3 of my favorite defensive stocks for 2023 on the US market. Dividend growth investors, bonjour, this is Mike Yahoo. I'm the founder of Dividend Stock Rock, and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And to enjoy your retirement, well, you need those sleep at the stocks, right? So today we're going to look at those companies. When I did that research using Dividend Stock Rock Stock Screener, I've put some minimum requirements. So the first one was a minimum rating of 4. So I wanted DSR Pro rating of 4 and above, so 4 or 5. So either like great buys or exceptional buys, and also a dividend safety score of 4. So companies that will show at least a mid-single digit dividend growth rate, long-time dividend growth, and more potential in the future. I also made sure that I had a minimum of a minimum dividend triangle respected, meaning that I want to see revenue growing, earnings per share growing, and dividend growing over the past 5 years. Those indicators will tell me that the business is able to grow throughout tough times and they are on a positive trend. So that's not all the research that you can do, but it's a very good starting point. I ended up my research looking at some of my favorite Dividend Kings. You know, Dividend Kings, they show 50 consecutive years or more of dividend increases. So that means they went through a whole bunch of recession, market crisis, interest rate going up or going down, inflation going up or going down, and they never failed their investors. And this is the most important part when you are not too sure about what's going to come up next. The best way to do it is to look back in history and make sure that you select companies that have been proven to have a solid business model and they will not fail you. So today we're going to talk about, first one, PepsiCo, ticker PEP. I'm pretty sure you know it. You can see the dividend triangle here over the past 10 years. Most of the time you see revenue growing, earnings per share growing, and obviously dividend growing. The company has increased its dividend for 51 consecutive years so far, so on a pretty strong streak, to offer a yield of 2.70% and has shown a 7.5 dividend growth rate over the past 5 years. So we're talking about a mature business, yes, but that is able to pass along the inflation crisis to their customers and generate more money in terms of sales, in terms of profits, and in share that with their shareholders. So one key aspect of PepsiCo is definitely its diversification. You may not know that, but Pepsi is a lot more about snacks than it is about beverages. So you have 55% of their revenue coming from those lovely chips such as Lay's, Fritos, and my favorite, Doritos. And not like the cheese one, but the spicy one. On the other side, they also generate 45% of their revenue from beverages such as Pepsi Cola, Gatorade, and Mountain Dew. Having those types of products is great because even if you enter in a recession, people will continue to buy those. Those like comfort food, they feel great, they are usually associated with pleasure or a good time, and they're not that expensive compared to vacation or going to the restaurant. So if you don't feel that great and you are in a recession, you don't want to spend $100 to feel better, well, maybe that a good Pepsi and a bag of Dorito will do the trick in front of the next Netflix movie, right? So repetitive purchase, strong brands, and being available across the world. While 60% of their sales are coming from North America, mostly the US, the other 40% is coming from all across the world, which is great because for Pepsi, if we have a recession in North America, but things are getting better across the world, well then they'll be able to manage through it and still generate some revenue growth. On the other side, same thing, if we have a big recession in Europe, well, you can think of Canadians and Americans to eat chips and drink soft drinks to get a little bit better, and it will even out what's going on around the world economics. Number 2 stock as a defensive play for 23, Genuine Parts. Again, if you look at the dividend triangle, you can see that it shows a steady growth for revenue, a steady growth of earnings, and obviously a steady growth of dividend increases. Actually, GPC has increased its dividend for 66 consecutive years. I mean, that's like part of the mother of dividend growth companies. The company offer a yield of 2.16% and an annualized growth rate of for the past 5 years, of 4.4% for its dividend growth. So mid-single, low digit, not incredibly crazy in terms of dividend growth, but a very great sign of stability. Its secret, Genuine Parts grow through acquisition. So what is great about Genuine Parts business model is that it's operating in a highly fragmented market. So it makes it very easy to grow by acquisition. Genuine Part has been able to do that in North America for many decades, and now they're moving on to Europe and Australia, so making like offshore acquisition to find additional growth. I think most of the growth will come from there, while North America, it will be probably like just steady organic growth. The thing is, once you're in a recession, you don't think about buying that new Ford F100, 150, right? You're thinking about repairing the one that you have in your driveway. So you're going to buy more pieces, more auto parts, and this is where Genuine Parts will come into play. So they offer a steady business model where we always need to repair our cars. And in times of recession, it will be a lot more likely that they will grow their revenue versus new cars manufacturers. Finally, what I like about Genuine Parts is the way they allocate their capital. So as you can see on this graph, the bulk of it is going through mergers and acquisitions. So they keep growing using the same strategy. They have gained scale, they have gained expertise, and they're now present a little bit more across the world. So they are able to grow their business using their capital that they're generating from their stronghold in North America. They also buy back shares and they also increase their dividends. So there's a great way from the company that they are able to create value for shareholders, which is definitely interesting, especially if you're not too sure where the economy is going to go. Well, you know that Genuine Parts will be around for many decades to come. So before I jump to number 3, I would like to invite you to go in the link description below and download the full list of Dividend Kings. So you'll have my favorite ones, some more analysis, and some more context around those companies that have been increasing their dividend for the past 50 years. It's a great place to start. It doesn't mean that all Dividend Kings are great, but if you download the list up there, down there, you'll get a good starting point for 2023. So now let's move on to the number 3 of this video, Abbott Laboratories, ticker ABT. Do not forget that Abbott Laboratories spun off AbbVie about 12, 14 years ago, like a little bit more than a decade ago. So they decided to focus on medical devices, nutrient supplements, and diagnostic medical devices along with generic drugs, and they left all the new drugs with the big pipelines and the heavy capital expenditure to invest in R&D to AbbVie. So they kind of like smoothed down their business model to show a little bit more of revenue growth, earnings growth, and dividend growth as a steady business model. ABT offers a yield of 1.81% with 51 years of consecutive dividend increase. And what is the most interesting part of it is they were able to surf on the last COVID by producing COVID tests. So they were quite generous with their dividend increases. If you look at the past 5 years, we're talking about double-digit dividend increase, 11.6% annualized growth rate for the past 5 years. The secret of their success is definitely to focus on a great variety of products around healthcare. So we're talking about cardiovascular healthcare, diabetes care, diagnostic, you got like some nutrition and medicines. So they go a little bit everywhere. They produce a lot of things that goes with repetitive purchases, and the nutrition products that covers infant formula all the way up to the popular Ensure for seniors in our community. So what is great is you have a lot of repetitive purchases, you have a lot of medical devices and diagnostics equipment that will be used by hospitals that are pretty much essential for healthcare, so we're not going to slow down in buying those products as population will continue to age for the next decade. Well then, there you go, you'll have more sales opportunities. Obviously, in the most recent quarterly update from Abbott Laboratories, they reported revenue going down because they had problems. They had to recall some of their formula. Last year, they had to shut down their plant, and obviously it created a revenue drop. This is the type of risk that you will going to enter when you invest in a healthcare business. It happened to Johnson & Johnson before. It happened to a bunch of other companies as well. So you just have to be aware that sometimes they will hit a bump in the road. Sometimes something wrong will happen with their formula or with their diagnostic equipments. But like over time, what I look at Abbott Laboratories, those 51 years of consecutive dividend increases tell me that they're trying to be as good as possible, as transparent as possible, and they try to manage those kind of problems the best way possible. Overall, if you have looked at those three companies, you will notice a few things that they have in common. Most of them, they have strong pricing power, like they have also repetitive purchases, and they show not so great yield. So a lot of people will tell me, but Mike, what about those amazing defensive plays paying 5, 6, 7% yield? Well, I don't see them as defensive plays because most of the time when they offer a higher yield, they will not show a long dividend growth streak and they will show some problems. And then you have to realize there's no free lunch in finance. So whenever a company is paying you a higher yield than all the others, it's because there are higher risk involved as well. So maybe the investment will turn out well, but again, if you're looking for something defensive, if you're looking to sleep well at night, maybe this is not the first list that you should draw is the high yielder, but rather the long-term dividend growers. Even then, you have to do some research. I'm providing you a complete list of the Dividend Kings with a lot of metrics, so you can filter those that are struggling right now. I'm thinking maybe of like 3M or VF Corporation that are more like educated guess or falling knives right now, as versus to if you look at Genuine Parts, PepsiCo and Abbott Laboratories. So I hope that you have enjoyed this video. Don't forget to download the list right below. And I'm very curious about what is your favorite defensive play for 2023. So just hit the comments section below. Let me know which defensive stock that you love, either on the US side or on the Canadian, because next week we're going to talk about the most defensive stocks in Canada. So until then, don't forget to stay invested.